A warm welcome to Energy Frontiers edition for the week, proudly supported by the African Energy Chamber, the leading energy sector advocacy group on the continent and headquartered in Johannesburg. I am Justina Okechukwu. As always, we begin with some of the biggest energy news making the headlines around the continent. BW Energy, listed on the Oslo Stock Exchange, has signed a deal to buy around 16.8 million common shares and 16.8 million warrants in Reconnaissance Energy Africa for a total of $16 million, including a 20% interest in the onshore petroleum exploration license 73 in Namibia. According to the Norwegian firm, the exploration license targets an unrisked resource potential of 489 million barrels of oil. Invictus Energy has announced an extension of its exploration tenure for the SG4571 license in Zimbabwe's Cabora Bassa Basin for another 3 years, effective until June 2027. The Oil and Gas Independent says it plans to begin comprehensive work program, including 3D seismic acquisition and additional exploration and appraisal drilling during the period. Egypt has issued an international tender to import around 740,000 tons of petroleum products for delivery in August. The tender includes 400,000 tons of diesel, 170,000 tons of gasoline, and 170,000 tons of butane. The initiative aims to meet the country's rising energy demands and secure a stable fuel supply during the peak consumption periods. London-based independent power producer Globeleq will be pumping its latest multi-million-dollar fundraising into Mozambique's first wind project. Globeleq says the investment monies of $99 million in debt financing and another $80 million in political risk insurance were secured from the United States International Development Finance Corporation. The Mozambique's 120 megawatts Namacha wind power plant in the Temane province will raise Globeleq's growing portfolio in southern Africa. An independent power producer known as NG has started the construction of the 75 megawatt Goodspoort solar photovoltaic power plant in South Africa's Free State. The project is one of 2 PV power plants being developed by NG under Bid Window 5 of the Renewable Energy Independent Power Producer Procurement Program. Delight, a solar lighting company, has secured a fresh $176 million securitization facility from an impact investing company to purchase receivables in Kenya, Tanzania, and Uganda. The multi-currency facility will allow Delight to provide off-grid solar power to an estimated 6 million people across these 3 East African countries over the next 3 years. And that's the summary of your energy news headlines. Dangote Refinery has set ambitious targets for the future, and that's what's next on Energy Frontiers. Welcome back to the program. Nigeria's Dangote Refinery, described as the world's single train facility, could be a game changer not just for Nigeria's energy sector, but for the entire continent. With projected annual revenue of $25 billion, the facility has the potential to deliver significant value, including fuel prices, government revenue, and regional collaboration. Last week, Aliko Dangote, the billionaire businessman and largest shareholder of the big facility, says plans are on to list the new refinery in the first quarter of 2025. So I sat to an interview chat with Joseph Nwakwe, oil and gas professional and partner at Zera Advisory and Consulting, on the Dangote Refinery potentials and future plans.
Well, in terms of price discovery, it might not impact it greatly. But I will say this: the refinery has been built with a significant amount of debt. So I imagine that coming to the market is Dangote Refinery's way of kind of restructuring their capital to include significant amount of equity. So I understand that he already has significant equity, but there's a lot of debt. So he's trying to change his capital structure a little bit. And so it might have two implications. One is it will reduce the pressure on him. I mean, generally speaking, debt is more expensive than equity. So the pressure on the managers of the refinery to do well will be much reduced if he has a diversified shareholding through, and then of course reduces the amount of debt in their book. So I suspect that what they are trying to do here is to restructure their capital, reduce the pressure on the management, and will that have direct implication on pricing of the commodity itself? I would say it will have very minimal implication because the owners of equity will equally require some returns on investment.
Right. Now, you mentioned something very significant, and that's the significant amount of equity that this would pull in as well. Now, how much of the projected $25 billion revenue will translate to tax revenue for Nigeria?
Okay, so the 25, this revenue is refinery revenue, you mean? Remember that refinery is in a tax-free zone. So if I understand your question, is how much taxes will this refinery bring to the government?
Yeah, right.
I will say, so it's, we have to think about it this way. The Dangote Refinery is in Lekki-free zone. That's an export processing-free zone. So it will not have, it's not subject to local taxes. It's not subject to both federal, state, and local government taxes. So it will not pull in directly a lot of tax. Okay, but there might be some other indirect benefits because it's in a place where importation of inputs, machinery into that refinery is duty free, right? So government doesn't get any custom duties and all that from doing that. Government does not tax it directly, whether it's it or any other tax, they are exempt. So the implication for the taxman is that it's almost like you have a foreign refinery on your soil. So you're not going to be able to tax it directly.
Tax them. Now, that revelation about NNPC's stake being reduced to about 7% or 7.2%, will the reduction in the stake make the refinery more susceptible to price pressures from the global oil markets?
The reduction in the equity by NNPC, I think, is a realistic position they took. They just didn't have the resources to pay the difference. So will it have implications for the entity itself? My sense is that they are coming to the market. So whatever the NNPC held, they will probably sell it to you and I, right? So that will not be a problem. So will it have implications for their ability to complete the project? Those are the real questions. I think they're almost there, so it might not impact their ability to stream PMS and all that. So I don't think it's overall. I think the 7.5% is better than nothing, if you ask me, or 7.2% that NNPC is keeping is still better than not having any stake at all. But I would have wished that NNPC was able to maintain the 20% that they had initially.
We are done dreaming of an industrialized Africa. No more enduring long journeys in darkness. No more imagining life without constant power. We are done. We are done. Done tolerating 24 hours without power, load shedding, blackouts, and power cuts. Enough. Imagine a life where our abundant natural resources can't power a generation. We can't cope with that reality. 600 million Africans still lack access to power. We have the solution. It's time to turn imagination into action. African Energy Week 2024 is the platform to implement change, sign deals, and take decisive action. And implement. Join us. Invest in African energies. Energy growth through an enabling environment, and be part of the movement that brings hope to millions across the continent. It's not just about power, it's about empowering lives and giving African hope. Be there to witness the transformation. African Energy Week 2024, where imagination becomes reality. Secure your seat now. Don't miss out on African Energy Week 2024. Visit our website and buy your tickets today. Let's light up Africa and create a brighter future together.
Project. By the time you need to build that project. Sign, baby, sign.
This is Energy Frontiers. The EU gas storage levels are currently in a robust position to reach the 90% fuel target by the start of the heating season. That was according to the International Energy Agency, or the IEA. While the global gas market has seen mixed trading since the beginning of the year, the IEA says it expects global gas demand to grow below 2% year-on-year for the second half of 2024, and that's down from 3% in the first half, with an overall increase of 2.5% for the full year, driven largely by the Asian markets. Paul Hicken is the editor-in-chief at Petroleum Economist, so I asked for his industry insights into the latest projection on the gas market by IEA.
Yeah, so I think what's interesting is it's important to note that Europe again has filled up its storage quickly ahead of time. It doesn't want to be caught short in terms of any risks around winter shortages. So it's really, and those price spikes we saw a couple of years ago. So it's really filling up quickly. That's playing into the factor. Another thing is important to note is the long-term trend is how much gas is going into European power generation. And that's a trend that's starting to reduce. It has been reducing for a while. We did see a snapback because of energy security concerns, and even coal come back into the mix, especially like places like Germany and others, and even the UK to some degree as a result of the security concerns. But there is a general trend to take fossil fuels out of the European power generation mix where possible. And that is the longer term trend. And that is why you're seeing this shift towards other big demand centers for gas, Asia, and the global south generally.
Right. There's a saying that goes, never to be caught on fresh. And that's probably what is happening in the EU on that storage front. Now, the report also highlights strong growth, particularly in Asia, like you mentioned. What factors are driving this demand, especially for fast-growing economies like Africa? Do you believe this growth trajectory is sustainable?
Yes, I think so. I think you look at what's happening in terms of gas, and you think that is the long-term fuel for base load power, for sustainability, because what you're really seeing, what's often neglected in sort of policy circle discussions, is that coal to gas is a huge leap forward in terms of clean energy generation. And we often talk about gas being a fossil fuel, but it's much cleaner than coal. And that is where you're really seeing the substitutions, especially across Africa, Asia, Latin America, those areas, and where the cost of renewables is so high. Yes, there's certainly investments going into renewables, but I think what you see is that both the energy companies, the oil and gas companies, and the policymakers, environmentalists like to lump gas in as a fossil fuel. And yes, it is tied to oil. It is a fossil fuel. But at the same time, those are sometimes political ends, because actually gas should be freed from that sort of label in a way. It should be seen as much more as a cleaner potential fuel of the future. And I think what you're seeing, especially in Africa, is huge amounts of investment going into gas as an important long-term fuel, both for domestic use and as a LNG, as a way to export. And what's very interesting in Africa, I think in particular, is it's not just gas was often seen as a very North African product, Algeria, Egypt, Libya as well. And what you're seeing now is sub-Saharan Africa is really investing in gas. You know, traditional oil producers like Nigeria, really going strongly on gas. Other traditional oil producers like Gabon have a master plan for gas. So it's going across sub-Saharan Africa, investments in gas. And traditionally, gas was probably seen in Africa as a kind of an unnecessary and extra costly product of the oil process, where oil was where all the money was at. But that's changing, because it certainly could fit into a much cleaner long-term energy mix, especially, like I said, away from, coal. While often there is a lot of investments in renewables, which is cleaner than gas, still gas offers such a big long-term, sustainable, reliable and cheap option. And the trick is that actually gas is still more expensive than coal. So you're still seeing a lot of investment going on in coal across Asia and elsewhere because it's cheaper. But actually, it's still only if you get enough gas into the market, if you're seeing the investments which is around Africa, you could potentially see a lot more gas on that market, bring down prices and make it more competitive as a long-term sustainable solution.
You can visit our website at frontierafricareports.com and our YouTube platforms to watch Paul's entire interview, as well as our other niche interviews of the show. The program lineup for this year's African Energy Week conference is robust, with well-rounded conversations, providing a platform for deal signings and linking energy, technology, and service companies with African energy projects. But that's not all. The Cape Town event, scheduled for November 4 to 8, will also feature town hall-style meetings to allow energy stakeholders from banking, private sector, service companies, government parastatals, and operators to drive energy growth in Africa. For more details and to register your spot, visit the event website at www.aecweek.com. And that's the package of Energy Frontiers for you at this time. We appreciate your making the time to watch the show as always. Remember to follow the weekly program on Frontier Africa Reports website, like all the video editions, send in your comments, and subscribe to our YouTube. Kindly follow us as well across all our social media handles as indicated. I am Justina Okechukwu. Bye for now.